Hello traders, Gary Wagner here. Approximately 1:30 in Honolulu, 6:30 in New York on Tuesday, 30th day of November 2021, and this is the daily report for gold and silver. As you can see through comments in our opening letter, we had some wild gyrations in terms of pricing of gold and silver, trading to extreme highs during the first part of the session and then selling off dramatically as Chairman Powell began to speak to the Senate Banking Committee today. We'll cover the technical levels that we are looking at in gold and what our short-term outlook is for both gold and silver, all on today's daily report. An extremely volatile day in all of the financial markets, including gold. Gold traded to a high well above $1,800, reaching $1,811.40 on fears of the new variant Omicron, and then a testimony by Chairman Powell before the Senate Banking Committee took all of those gains, and we had gold closing lower, trading to a low today of $1,771.20. And as of 1 o'clock in Honolulu, 6 o'clock in New York, we have gold at $1,776.20, a net decline of 0.5%. Or $9. Now, that happened concurrently with weakness in the U.S. dollar. The dollar lost about 0.4% and is currently fixed at 95.91. And lastly, silver actually showed a gain today, fractional, up about a penny, and is currently fixed at $22.86.5. To give you an idea of the extreme volatility that we have seen in gold as it traded sharply higher in the morning, taking it to a high of just above $1,811, and within a half an hour time period as Chairman Powell spoke, taking a virtual nosedive from $1,811 down to these lows at approximately $1,772. As we speak, gold is down $9, and we could see a further decline in the upcoming trading days. We will address that when we look at some longer-term charts. Over the last 3 trading days, we have had 2 of those days result in extremely volatile trading ranges with exaggerated highs reacting to one factor and then closing lower on the day. That would be Friday as well as today, Tuesday. They look similar, although the open to the close is more pronounced in today's candle. What we are seeing is a lower low and a lower high when we compare today's high to that of Friday. Clearly, we are trading under pressure. Yesterday, I spoke about key and critical price points that we need to watch, one of them being this long breakout line that we used to determine that gold was actually breaking out as it traded above $1,800 per ounce. Now that, I believe, has become our area of resistance. We have clearly closed below that now for the last 4 trading days, and a weak level of support is at about $1,770. We did not see gold close above this particular price point, and if you recall from yesterday's show, we talked about not only closing above this price point, but closing or at least challenging $1,800 per ounce. So we are currently looking at resistance at 1785 and then again at 1800. In terms of levels of support, we have to acknowledge this particular level, which is the 38% retracement level at $1,770.40. And below that is this particular low that came in on November 3rd when the market traded to a low of $1,758 per ounce. This is going to be a key price point if we see a further decline, because if it breaks through this, there really isn't any major support that comes into the market before the 23% retracement at 1733.90 and the low that we saw gold trade to, which was even a couple of ticks below that price point at about 1725. As we addressed in our opening letter today, there were 2 primary events that occurred that took gold substantially higher and then substantially lower. The highs were achieved when statements and concerns were raised about this new variant Omicron in regards to the current vaccine's efficacy. In interviews, Moderna CEO Stefan Bancel predicted that the current vaccines are likely to be less effective against the emerging Omicron variant. And he also said there is no world, I think, where the effectiveness is the same level we had with the Delta variant. However, the bullish market sentiment, due to statements made by the CEO of Moderna, as well as the World Health Organization, quickly diminished once Chairman Powell, in a testimony to the Senate Banking Committee today, really backpedaled on many of their statements, and rather than acknowledge that the Federal Reserve has simply put got it wrong in regards to inflationary pressure, made some very interesting statements to indicate that it wasn't the Fed that got it wrong, but rather market sentiment or the people interpreting his statement. Specifically, he addressed the term transitory in regards to inflationary pressure, saying that transitory means different things to different people. Chairman Powell, it does not mean different things to different people. It means short term. And what we are seeing is persistent inflation rather than transitory. So the Federal Reserve really had no right to take it out of their vocabulary. Rather, they should have acknowledged their mistake and realized that anything they said would do nothing except clarify the fact that the Federal Reserve is acting in a reactionary manner rather than a proactive stance as the Federal Reserve needs to have in terms of their forward guidance. In other words, they realize they got it wrong. They realize that they quickly have to adapt to changes in the economic environment, specifically inflation. And rather than acknowledge that fact, they are absolutely backpedaling with these types of statements. Yesterday, we looked at the Henkin-Ashi chart. This is a daily candlestick chart in Henkin-Ashi format, in which we said that there was a reasonable probability that we could see a pivot or key reversal if we saw gold hold $1,785 and close above this breakout line that I believe is now the resistance line for gold. Clearly, that didn't happen. Today's statement by Jerome Powell clearly laid out a much more hawkish stance and forward guidance than previously thought. It was believed by many analysts that the Omicron variant could make the Fed go back on their statement of accelerating the timeline to a much more dovish stance to take into account the economic fallout that could occur from this new variant. We're looking at a three-line break chart, the analogous chart to the Western point and figure chart, in that it takes out the element of time and rather looks for price changes before making a new candle. In the case of today's action, it clearly is referenced through the eyes of a three-line break chart as the continuation of the current bearish trend. Although silver trading overseas is currently up by about 5 cents on the day when it's compared to the close of today's action in New York, we are clearly below $23 per ounce, which we have identified as a key level to watch, specifically $22.96, before we would in any way say that there is some kind of key reversal or pivot that is possibly in play. Based upon this recent action, if we continue to see selling pressure, the place we want to look at for the next level of support does not come in till about $22.30 to 35 cents. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the next daily update and review. Bye-bye.